That we recognize the gentleman from Arkansas, Mr. Hill, who is an addition to our committee today. He's one of our important members of the full committee, but he's also the sponsor of one of the bills that we're considering today, and look forward to his discussion. Mr. Hill, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate you and the ranking member holding this hearing. Thanks for letting an interloper from the committee come and be a part of your hearing today. And thanks for your work on the SIFI designation. I think so many people have simply tried to move the number from 50 billion to a higher number, particularly over in the Senate. And I think if I were a regulatory policymaker, I would want a much more substantive activities-based approach. So thank you for your leadership on that. We're back talking about TRID today. We've talked about that a number of times in this committee since the rule was finalized back in 2013. The origin was, of course, under Dodd-Frank to ask the CFPB to consider merging the truth in lending disclosures with the real estate settlement disclosures. The intent was a streamlined, simpler, better form for consumers that's sort of like the guy who wants a thoroughbred and goes into breeding and produces a camel. We really didn't get that, and in 2015, when the rule went final, it had so many problems with it that the House overwhelmingly passed my bill, the Home Buyers Assistance Act, 303 to 121, which was to try to delay problems with liability associated with trying to implement this rule. Again, the CFPB recognized that they had trouble with their rule, and they re-proposed it and asked for more comments, and those comments poured in. And then in April, Director Cordray testified before us, and I discussed with him the problems I had with the lack of clear, legally binding guidance coming out of the CFPB generally and on TILA-RESPA in particular. So today, we tackle one of those small challenges, and I appreciate Mr. Tuggle and Mr. Quadman's comments on this bill. This bill does two things. Number one, it tries to make sure that we provide accurate information in a very confusing part of the rule, which is disclosing what is the title cost to the consumer. And you can see on your screen, the rule attempts to make a marginal cost analysis. It's on the left. That's what the CFPB currently describes or prescribes for title companies to disclose on that closing statement. But it doesn't really, in my view, do a very good job of it. So part one of this bill simply says we think that the accurate, actually charged amount for the owner's title policy, that the seller typically pays to cover their reps and warranties on that they have good title to the property they're selling, and then the lender's policy that is typically paid for by the borrower that's covering liability on closing the loan. Mr. Quadman, pretty confusing. What are your thoughts on this part of the bill's change?
I think it's very welcome. I'm laughing a little bit because in a prior life, I didn't do as many real estate closings as Ms. Tenney did, but as a recovering lawyer, I did my fair share. And I think you point out the problem that the rule itself doesn't convey appropriate information to consumers, nor, I mean, with the passage of the Dodd-Frank Act, we were supposed to help consolidate and streamline closing documents, and clearly we still have a lot more work to do, and I think this bill is an important first step to trying to do that.
I appreciate that. The other portion of the bill that was referenced by my friend from Minnesota is trying to align the errors in the bill from 60 days to 210 days. The logic here was to align it with what Dodd-Frank's rulemaking prescribed on the qualified mortgage rule of 210 days. It's not a number pulled out of thin air. It's pulled out of one of the most important rules that came out of Dodd-Frank, which is trying to define a qualified mortgage and then defining that for the secondary market. So we attempt to align that error discovery process for TILA-RESPA to that 210-day note that was a result of qualified mortgages, also a part of Dodd-Frank. As I say, this is a 1,800-page rule trying to merge these forms. I've heard lots of comments from my bankers Some of them have tongue-in-cheek said that TRID stands for the reason I drink, which is, as I say, tongue-in-cheek. But it's seen a lot of product problems for consumers. One-time closed loans are now very difficult to do, if not impossible, under the combined form. And so I think consumers have been hurt. Closing times have been extended. So I'm pleased that this is a good step forward, and I thank the chairman for letting us have that discussion today.